Most people ask me, should I be a limited company? And that's the wrong question to start off with. I'm Mustafa, I'm an accountant, and proper tax planning doesn't start with just looking at your structure. It starts with your goals. So let me show you how we actually do this. So when someone comes to start talking about tax planning, they usually jump straight into the deep end and start talking about tactics. They ask, should I incorporate? Should I take salary or dividends? Can I claim this so-and-so expense? Now, these are all the wrong first questions because tax planning isn't about all these tactics. It's about strategy. And strategy, it all starts with one thing. What are you actually trying to achieve from this business? So let me walk you through exactly how I approach tax planning with all of our clients. So step number one, what are your goals? What's the 5 to 10 year view? So the first step, I make you step back completely. What's the actual goal here? What are you trying to do in the next 5 to 10 years? So in this section, the typical questions that I'll ask are things like, what does success look like to you in 5 years time? Are you trying to build a £1 million business and sell it? Are you trying to generate 100k a year passive income for yourself? Are you trying to replace your salary and have a little bit more flexibility? Are you trying to build something to pass to your kids? Or do you want to actually just scale quickly and get loads of investment in? Can you see different goals will require different tax strategies? Next up, I ask, what's your risk tolerance? Are you conservative? Are you aggressive, or are you somewhere in between? Do you like big risks or do you hate them? Because this is going to completely affect every single thing that we do. Next, I want to know what your exit plan is for this business. Are you planning to sell the business in 5 to 10 years time? Are you going to run it forever and take dividends? Are you trying to build something to employ your family potentially? Or are you just completely not sure yet? Now, the reason we ask this is because if you're planning to sell, we'll optimize for capital gains. And if you're planning to hold forever, we'll optimize for optimum income extraction. These are two completely different strategies. The next step after this is, what are you doing with your money? Are you reinvesting everything into growth? Are you taking money out to live on? Are you trying to buy property? Are you building a pension? Do you want to save for your kids' future or education? Because once I've got all this, it tells me exactly how much that you need to extract from the company. It tells me when you need to extract it, and it also potentially gives me an idea as to what tax wrappers we can use, like ISAs, pensions, things like that. Now, step two is, what's your current situation? This is the real reality check for you. So the second step is essentially, I want to know where you are right now. Not where you want to be, but where you are. Now, within this step, the questions I typically ask are, what's your actual profit? Not your revenue, I want to know your profit, because tax strategies work completely differently at 30k profit versus 100k profit. So we need to know. Next, I need to know what your cash flow is like month to month, week to week. Are you cash rich? Are you cash tight? Or is everything very unpredictable at the moment? Now, next up is the big one. What's your personal financial situation like at the moment? Do you have a mortgage? If so, how much of a mortgage do you have? Do you have dependents? Do you have any other income sources from anywhere? And have you got any existing current pensions or investments? Because all of this pulled in together is going to completely affect how much you need to take out from the business. It's also going to affect what tax band you're in and which type of planning makes sense for you. Now, step three, this is where we identify the gap. So I want to now in this section identify the gap between where you are right now versus where you want to be, and try and help you bridge that gap. So let's say currently your situation is you're a 40k profit making sole trader and you take everything out personally, and your goal is a 200k business which you want to sell in about 7 years time. Now, the gap between them two is that you need to 4 or 5x your revenue just to achieve that goal. Now, this is where we can actually plan. This is what needs to happen. So you need to grow your revenue. You want to get from 40k all the way up to 200k after 7 years. We may also need to change your structure, because a sole trader won't sell versus a limited company might be a little bit easier. We then need to help you build some sort of systems, because this business, it needs to run without you being involved. We also want to reinvest profits. We don't want to take everything out because we want to fuel it for growth. And finally, we need to optimize this business setup for capital gains tax, not necessarily income tax right now, because you're planning to sell. So can you see how this is strategy and not just a simple question of, should I be a limited company? We're trying to build a roadmap out here. Now, step 4, now we finally talk structure, because now we know what you're trying to achieve, where you are now, and how we're going to bridge that gap. Now, within this section, the common sort of questions are, should you be a limited company or not now? Now, this entirely depends on your situation. Is your profit level under 50,000? It might not be worth it. What are your goals? Are you planning to sell? Then definitely limited company, it'll be better for you in the longer term. What's your risk exposure like? Are you in a high risk industry? Then limited company is definitely better for protection. And finally, your cash needs. Do you need all the profit? If so, then sole trader might just be simpler for you. Next, we talk about how should you extract the money now. Now, if you're a limited company, you want to pay yourself up to the personal allowance, which is £12,570. And then you want dividends for the rest. And it's very different. Let's say you need a mortgage and you want to show higher income, then of course we're going to have to bump up your earnings. Or if you want to end up building a pension pot for yourself, then again we'll optimize the earnings for taking pension contributions out. Again, you see here different situations require different tax strategies. And then next up, we can actually look at if you should involve any family members in this business. Now, if your spouse doesn't work or earns very minimal amounts, then this could be considered. If you're a higher rate taxpayer and your spouse can genuinely contribute into the business, then definitely you should consider this. You can split the dividends up, you can split your earnings up, and you can save tax legally. Now, the fifth and final step is when we now optimize. These are the tactics that we use. Because like I've said, tactics only work best when strategy is done right. So then we can talk about things like your expenses. What can you claim? Are you tracking everything? Are you using optimum calculations for these expenses? We can look at timing. When should you invoice? When should you pay your expenses? And can you potentially shift income between 2 tax years? Then you can look at your allowances like pension contributions, dividend allowances, capital allowances, all that sort of good stuff. And you can also get into the more technical stuff like business asset disposal relief, research and development relief, enterprise investment schemes potentially, even venture capital trusts. And finally, we can look at your overall structure. Do you need a holding company structure in place? Will it be more efficient for you or will it not? Do you need a family investment company? Do you need potential trusts being set up? But here's the key. These tactics are absolutely worthless if the tax strategy behind it is not right. You can optimize your salary versus dividend split all you want. But if you're a sole trader when you should be a limited company, you're still going to be leaving money on the table every time. So it's always going to be strategy first and tactics second. Now here's the reality of tax planning. It's not complicated, it's just very strategic. Most people seem to overcomplicate it because they skip that whole strategy part, which is key. They jump straight into the question of should I be a limited company, when instead they should be asking themselves, what am I trying to achieve here? What am I trying to build? Where am I now? And what's the gap so that I can bridge that gap? And if you answer those questions first, then structure, optimizations, and any sort of tax strategy falls into place itself. Now, good tax planning is pretty boring. It consists of things like proper bookkeeping, regular reviews, understanding your numbers, claiming what you're entitled to, and key is planning 12 months ahead. And it's not complex offshore accounts, aggressive tax schemes, and last-minute panic moves. What you need to remember is boring usually works best. So if you're watching this thinking that you've been doing tactics without any strategy involved, you've now got 2 options. Option number 1, keep doing what you're doing, optimize little bits and pieces and hope it all works out in the end. Or option number 2 is you build a strategy first and then optimize for any sort of tactics. You can book in a free discovery call with me. The link is in the description. We'll literally start with what are you trying to achieve in the next 5 years time and work it right back from there. Because here's the thing, tax planning without any strategy is simply just guessing, and guessing will always cost you more money in the longer term. So click below and get booked in.